one of the differences this time is that because a lot of the activity is happening, especially in these kind of like more, let's call it like gamble-fi, highly speculative, really zero fundamental value assets are happening on Solana and some of the ETH L2s. I've been personally surprised by the kind of persistence of the like further out on the spectrum, kind of maybe let's call it like more left curve narratives.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic from 4RC. Today's show spotlights one of the most relatable and reputable crypto investors we know from Mechanism Capital, Marc Weinstein. In this episode, Marc provides us insight into how far along we are in this bull run, why this time is and is not different, where he sees investment opportunity this cycle, and how attention dispersion plays such an important role in our buying and selling behavior during crypto bull cycles. But before we do, just a quick word from our sponsors who make the Edge Podcast possible. Introducing Flat Money, the first decentralized, delta-neutral FLATCOIN built on Base with sustainable yield that's completely untethered from legacy finance. Because DeFi needs an uncensorable based unit of currency. You can mint unit with RETH, which is held in the protocol's shared liquidity pool, where it's borrowed by leveraged traders. As a leveraged trader, you can deposit your margin collateral and go long on RETH. If you're trading in the perpetual futures market, you'll pay unit holders to open leverage positions. If you're holding unit, you'll earn yield from liquidations, borrow rate, and trading fees. Preserve your purchasing power and offset your exposure to crypto market volatility. Learn more at flat.money.
Restaking summer is dawning, and SWELL is expanding. Harnessing the power of RSWETH, SWELL is building the Layer 2 for liquid restaking. That means native restaking yield on a chain built with Polygon's ZK EVM technology in collaboration with AltLayer, Chainlink, and EigenDA. Look out for SWELL's Layer 2 in Swell City.
Introducing the MANTLE liquid staking protocol, MANTLE LSP, a permissionless, non-custodial ETH liquid staking protocol deployed on Ethereum L1 and governed by MANTLE. With MANTLE LSP, users can stake ETH to instantly receive METH, earn yield and accumulate rewards the longer you stake. METH is the value accumulating receipt token that will give you access to expanded yield opportunities. Stake and watch your yield grow with MANTLE LSP.
Introducing KELP DAO, the first liquid restaking platform for LSTs. With KELP, anyone can deposit STETH by Lido, ETHX by Stater, or SFRX ETH by Frax, and mint a liquid restaking token called RSETH. With RSETH, you can participate in your favorite DeFi platforms and get 100% of all EigenLayer points, plus KELP miles. A fresh wave of restaking is here, restaking that's liquid, rewarding, and convenient. Learn more today at kelpdao.xyz/restake.
It all started so simply with CryptoKitties and Maker on Ethereum, but quickly became complex with more applications and many chains. Today, everyone agrees UX issues are the biggest blocker standing in the way of crypto adoption. Introducing Avocado. Multi-chain UX redesigned from the ground up. The first wallet to abstract networks, accounts, and gas. One gas tank to pay transaction fees on all chains, in USDC. And native access to INSTADAPP's powerful, custom DeFi strategies. Avocado, one wallet to rule all chains.
All right, let's introduce Marc Weinstein, partner at Mechanism Capital. Marc, welcome to the Edge Podcast. How are you doing?
Thanks for having me, guys. Excited to be here.
Part of the reason we're excited to talk with you, Marc, is, we've had discussions previously just about how we invest as, part of a VC or even as angels. And there's no doubt we all resonate with just understanding people. And whether that's understanding founders or understanding ourselves and others as users, I think that's one of the superpowers we have here. Might be the only superpower I have. I'm not sure if I have any other superpowers here. But we're hoping to also just dig into what's top of mind for you. I know Nomadic and I have lost a lot of sleep over like where we are in this cycle, what narratives are still yet to play out, what bubbles, will burst this cycle. So anyways, super grateful just to have this opportunity to talk with you as a peer about all of this. But Marc, for folks that don't know you or Mechanism, why don't we just kick off with a little bit more about like, what were you doing prior to crypto? Can you give us the highlights reel of Mechanism and some of the work you've done over the years?
Yeah, for sure. Have had a very varied career. And now it's been, I guess, almost 15 years. So this gets longer and longer. I'll try to keep it short. Studied finance and economics came up during the financial crisis, and basically in 2008 as a junior, the most important year for recruiting, the entire global financial system came to its knees and almost collapsed. The largest recruiters on campus disappeared, and every professor that I had, no one predicted it. And there were a few professors that could actually explain what had happened 1 year later. And so I started kind of building a different framework than what was taught at some of these institutions, and that was kind of more of the Austrian school of economics, hard money thinking, etc. As we were entering this kind of like quantitative easing period. Got out of college, was happy and lucky to have a job in investment banking, paid well. I felt like I owed it to my parents to take on a big boy job, even though I hate shaving. I had to do it basically twice a day in the office. Worked at Jefferies on the M&A team, then Morgan Stanley on the sponsors team, doing, debt financing for LBOs. At the time, there weren't really any IPOs happening. And I quit banking after 2 years, turned down a job offer in private equity, which for a few years felt like a huge mistake as I was a struggling entrepreneur. And the private equity fund that I turned down grew from 1 billion to 100 billion under management in that time. But I took a shot. And my best friend and I at the time built a company that was meant to provide inflation protection to institutional investors that wanted an alternative to inflation-issued securities by governments. We thought we were going to build a $100 billion asset manager, and we failed miserably, fell on our faces. He went on to work on his family real estate company, and I was struggling to figure out what was next. Did a bunch of odd jobs to pay the bills, SAT tutor, became a yoga instructor, and was advising startups on basically like financial models as like a small business banker. Landed one company that was doing music festivals and became like a CFO for this company, Prime Social Group in the Midwest. Worked with them for like a year and a half, and then decided I wanted to start my own music festival, which I did. It was called 90s Fest. We were in 5 markets. We had like 50,000 attendees across the 5 festivals. Nickelodeon sponsored. It was kind of like a digital and IRL kind of mix. So really like thinking about like distribution and digital content and playing it back into real life. Between those 2 companies, between the events business and the financial services startup, I read the Bitcoin white paper for the second time. It had been making the rounds when I was at Jefferies. I kind of ignored it. 2013, I was like, wow, this totally resonates. The idea of digital gold, hard money asset online, everybody's attention is moving to the internet. Social media was really popping off. Like this was the beginning of Instagram era. And I bought a couple of Bitcoin. It went up 2x. I thought I was a genius. Mt. Gox happened. It went down 70%. I was like, all right, whatever, kind of forgot about it. Didn't want to sell it. Kind of felt like it was a 0 or 10,000x opportunity, but also wasn't like forward thinking enough to recognize this entire industry that was going to be created after. So pivoted to the events business, worked on that for a couple of years, sold 90s Fest in 2017, was looking for what to do next. Ended up as a consultant for a brief stint on a now infamous music festival called Fire Festival, which I think in a way trained me for crypto and for VC because I was kind of firsthand engaged with a founder that's now perceived to be, one of the biggest kind of like grifters of our generation, and kind of got to understand like those qualities a little bit better and what to look out for in people. And then was looking for the next thing and ended up full-time in crypto. Started at a family office in Los Angeles in 2017 during the ICO mania. Worked as a principal at Wave Financial until the middle of the prior bear market, where I went out on my own as an angel investor and advisor to a number of different projects in the space. And it was during this time that I reconnected with my partner, Andrew Kang. Andrew used to work for a group called Azoth and was doing some OTC deals for SAPs, and I had connected with him through that, and we did a couple of deals together, so built this trust. We went surfing in LA together and met IRL. And then, DeFi summer hit, and he, Daryl Lau, and Ben Simon were launching a fund right around the time that YFI launched, and we were all kind of in the trenches of DeFi summer, yield farming, all the food farms that launched. And the four of us partnered up to launch Mechanism Capital with, a base of capital that was predominantly Andrew's. We have no LPs. We still have not taken on limited partners into the fund. It's more of like a prop fund or a family office. And we went from liquid investing in DeFi projects to venture investing. I think our first venture deal together was Nansen. We co-led the seed round. We started thinking about what kind of infrastructure was necessary for DeFi. We got really interested in a cross-chain future. This was before MetaMask launched the Binance Smart Chain RPC. We invested in a project called XDeFi Wallet. They're still going and operating, kind of crushing it, 250,000 weekly actives, which is one of the largest wallets in the space, believe it or not. And just continue to grow and scale. We invested in Covalent, which was a cross-chain graph competitor. And then we saw the need for scaling, and we invested in Arbitrum, which was one of our first kind of like big checks into like a major leading infrastructure player, and that's played out really well. Since we've done, probably 50 to 60 deals out of that core fund across multiple verticals. We got excited about Web3 gaming early on, did the seed round of YGG, Merit Circle, Star Atlas, and a bunch of others. And, have also been personally investing in NFTs. We all are on chain. We're all in Telegram and Discord nonstop. I mean, we kind of like eat, breathe, and live this stuff. I just rambled for a long time, so I'll pause there.
It's fascinating to hear all that, because I have truthfully never gotten that like background story to Mechanism. Like I had no idea whether you had LPs or whether, it was seeded like through Andrew's money. But this makes a lot more sense now. Like I have at times like admired your willingness to ape when the time is right to ape. Like I feel like you guys have been quick to recognize the shift in momentum, whether it was the last bull run or this bull run. And I do think, for better or worse, I think that some funds, due to the PTSD that they endured during bear markets, they struggle to recognize that shift. And I think that obviously there's something special to focusing on the money that is your own. That said, there are things that are out of our control, and one of those is this bull to bear cycle. We have seen this somewhat repeatable 4-year cycle. It's not always been exactly the same, but it sure looks similar to every other halving cycle. And so I'm wondering, like, how are you guys thinking about the latest cycle? Like, there's been some notable differences. It's somewhat insane to see how we've like gone up so quickly prior to the halving. That's probably been the most notable difference. But how are you guys assessing like where we are in this cycle? And then how do you continue to, I guess, like harness the trend being our friend right now and everything being up and to the right, while you can still invest during this bull run?
Yeah, I mean, great question. I think it's one, I want to say like all these opinions are my own, and we have a ton of dissent internally. Like sometimes I think Andrew is subtweeting me, or like basically like we'll talk about something internal and then he'll tweet out, like imagine being bearish right now. And it's like, dude, come on. I know you're talking about me. So it's definitely like there's dissent, and we constantly debate these things, and we're sharing data points. And I would say you're absolutely right. This time feels different. And I know that that's kind of one of those tropes that you're not supposed to say. But really like the ETF, I think front ran this entire cycle, right? Like the there was still talk of like, is the ETF launch a sell the news as of like, a month ago, or like, I guess a month and a half ago. And, the inflows have just been absolutely insane and shown that there's been a pent up institutional bid for Bitcoin, that just couldn't touch it. And I think now we're in this new era for Bitcoin where, it solidified itself as an institutional asset. And I think the mistake that many people made over the last 12 months, let's say, is believing that it was a Bitcoin only phenomenon. And something that I've spoken to one of my friends, Tyler Reynolds, about is like, the Bitcoin wealth effect will always, I believe, impact crypto. So long as there are large holders of Bitcoin and Ethereum and some of the bigger assets who are making, big gains in their net worth, that wealth effect is going to trickle down into smaller assets where it's much easier for you to multiply your net worth with less capital because there's less liquidity. And we see it happen until a point of just absolute dispersion, and just like mentalness, where I think we can all almost like physically feel stretched, like so stretched, like people are out there chasing the next 100x meme coin. And, there's 50 meme coins across 10 different chains. And they're all going up. And eventually I think just attention gets so dispersed that we have to come back down. One of the differences this time is that because a lot of the activity is happening, especially in these kind of like more, let's call it like gamble-fi, highly speculative, really zero fundamental value assets, are happening on Solana and some of the ETH L2s. We won't hit this point that we kind of used to hit where we would see that dispersion, that rotation, and movement across the risk spectrum. And then it would kind of end with this like giga pump in ETH, which would spike gas and make it just so costly and difficult for any retail participants to even do anything on the chain that it was inevitable for it to just nuke back down. And I think that without that almost forcing function on the craziness, I've been personally surprised by the kind of persistence of the like further out on the spectrum, kind of maybe let's call it like more left curve narratives. I also think, to your point about Bitcoin, all-time high pre-halvening, it's the ETF, right? You have to point at that, billions in flows. It's insane. And I think what this leads to, if I had to guess, I'm not really a super cycle thinker. I actually believe that this leads to a top sooner this cycle. I think it's lazy to just assume that we're going to repeat a 4-year cycle. As we've seen from like, the metric that everyone was like, okay, when Coinbase hits the top 10 in the App Store, that's when you got to sell. And it's like, look how quickly Coinbase has fired up the rankings. And now the question is, if it hits the top 10 in the next month, are you really going to sell? And does that still work as like a proxy for a local top? It used to be that meme coins were a clear indicator that we were nearing a local top. And that's just not the case anymore. So do I know what's going to top us this time? No, but I do think it's almost like intellectually lazy to just assume that, okay, October 2025, that puts us on about that 2-year post, like year and a half post halvening. And then that's a good time to exit. And maybe we nuke in January 26. I just think it happens sooner.
Marc, just to follow up to that then, maybe like what do you think you'll be looking for potential top signals, like whether that be data-driven, sentiment-driven, and I'm assuming it's going to be a basket, like a number of things and data points that will kind of like build and maybe give you that confirmation. But yeah, what are you going to be looking for in that case?
It's really difficult because a lot of the classic signs are already happening. Like new Web2 instos coming in and announcing their blockchain project, right? Blockchain, not Bitcoin, or blockchain, not crypto type vibes. I think there was a big Web3 gaming company that just announced they're launching a subnet on Avalanche, a box. And, you know, the meme mania, for example, and the venture deals getting just completely ridiculous. And I hope we'll touch on venture markets because I usually use that as an indicator. I think venture capital investors like to believe that we're smart and we're not retail and we're forward thinking. But if you actually look at venture activity in crypto during bear markets and now, it shows that we're actually a lagging indicator. Venture market activity seems to follow price and not the other way around. And I think that, you know, there's almost like a weight that's going to be hit where the amount of unlocks at valuations, if there's not new capital that flows into some of the non-Bitcoin related assets, I don't know that there's going to be enough capital to hold that up. So it's like one of those things where I wish I could say I had like clear indicators now, but it's almost like every one of my indicators is already going off. I think we're near a local top. It's hard to say what causes that. I thought it might have been today. Like there's the CPI print. We've now been barely higher than expected the last 2 months. So if that's a trend, you know, risk assets will come down because people expect rates higher for longer. And I think that that's probably like one of the core things to look out for a local top here. But generally, I think you also like some of my friends who are the best traders, they hate price targets. But I think having a mental model of like, all right, every cycle, you know, how much has Bitcoin climbed and what amount of new capital is required to get it there before we top, and just like thinking out loud, a nice round number feels like 150K to 200K Bitcoin for me, where I would consider just based on like where we are price wise taking off. I will say that, you know, my gains are capped because I tend to be a little bit mid IQ and like in this desire to sell. Like I tweeted it recently, like just it's that time in the market where you literally just are better served sitting on your hands and waiting, even though, you know, maybe some assets you invested in that you didn't expect to go up went up 3 to 5x almost overnight. It's like I take profit and then the thing's up 30% the next day. I take profit and then it's up another 30%. And the right move was not to take profit, at least for now. It's just that I guess is a good strategy for someone who maybe is not trying to like 100x their net worth, but instead maybe like a 3 to 5x is enough. I mean, let's be real. Like we're the only industry that talks in multiples of net worth each cycle. Like every other space is satisfied with a 15% net IRR. So I think, you know, if your targets are not so insane, like taking profit may hurt in the short term, but we all know how tight the door gets on the way out. Liquidity just gets completely evaporated, and it feels nice to have some cash on the side. You know, IRL, go buy yourself, you know, something nice, buy your partner something nice, like, you know, look into having a home to live in. Like these things actually matter for personal account management. I'm going to stop there. Rambling again.
No, not at all. That resonates for me. I know last cycle we had been saving for years, and it was despite the bull run obviously being a great thing for our own portfolio, we had saved up, we were ready to buy a home, and you know, I kept it really simple. Like I mean, I'm in a different place probably too than like, I recognize if you're 22 years old and you're trading meme coins, like good for you. Like go out, you know, be as risk on as needed. You know, do with your money what you will. But, you know, for me, it was about being able to make incremental improvements to my life, whether it was like doing like a renovation or like replacing floors at home. That said, this is my third cycle. So I started in the bull run in 2017. So I've lived through then 2 bear cycles. I still feel like a newcomer. It's funny, like I'm gonna like talk like I'm some bit of an OG, but I feel like a newcomer when I look at friends who have been around since like 2011 or 2012. But the thing for me that's different this cycle as an investor is I know that I know not to mid-curve myself out of the pattern that repeats every cycle. Like, I'm not surprised by this run-up. It has come faster than expected, but at the same time, too, I'm not accepting that it's all going to play out exactly the same way. And so I'm paranoid and vigilant, like some sort of balance of the two. I'm looking for those telltale signs you mentioned, like, you know, the Coinbase app ranking is something that everybody sort of pays attention to, but you lose track of it when it finally goes to like the top 10.
There's a Twitter account that tracks it now, by the way, if you want to just put notifications on for that. I think we're already at like 36 or something, like insane. It's from like 350 3 weeks ago.
I think the other thing that I recall from the last cycle, the thing that felt the silliest was I remember people talking like flipping NFTs was easy and that, you know, it was kind of this game of like, if I had just bought this, I would be up 50 or 100x. I am recognizing some of that already, even though I'm still holding out that there's a chance that maybe we're only 50% of the way through the bull run. The meme coin trading has really taken me by surprise. And I'll put a cap on it with this, that I think your point about gas prices going up on Ethereum mainnet last cycle, that was almost like a parent looking out for all of us. Like the gas would shoot up and you would literally be priced out of doing transactions. Like a frustration basically set in. So like you weren't being hurt by the volatility of prices. We were still in this uptrend and things were amazing if you were able to just long tokens on a centralized exchange. But all of the opportunity on chain, it was limited because there was only so many of us left who were willing to pay at times, you know, $100 to do a transaction. This cycle, we have thriving L2s and L1s. And I think like, you know, it's clearly a consensus within the industry that Solana has taken over as like the casino. Ethereum held that mantle, you know, it held that role for many years. And I think
BSC.
And then you have BSC. That's right.
Yeah.
So we sort of rotated last cycle, but they all sort of benefited from the money that was shifting from Ethereum mainnet to BSC to Polygon to Avalanche, ultimately to Terra and beyond. This cycle, there's a lot of choices. You know, Solana, again, deserves credit for having like attracted so many users and so much money. But I think what you also mentioned earlier, Mark, about like just the attention game, like the competition for people's attention, it's one of the things that has me like, you know, somewhat worried and simultaneously frustrated, like in terms of like, where do I place my bets this cycle? Shoot, there's one other point here, I guess, to make that's so different from last cycle, which is the choices that we have to transact across different L2s versus just, I'm going to transact on one of those. I'm going to pick that as my home base, or in the world of like Solana, everyone's just on one chain, which reminds me a lot of DeFi Summer, where DeFi Summer was so special because all of us were using the same 10 or 12 protocols. And so all of our attention was in one place. And that's part of the reason things got so crazy so quickly, is because we had some choices, but the choice to transact on another chain really didn't come about until BSC started launching things like PancakeSwap. So anyways, just lots of similarities, but lots of differences this cycle that have me, you know, very confused at times and just, you know, somewhat unsure of like where the cycle takes us next.
Yeah, I mean, I think you nailed some great points there. Like one kind of mental model that I've had for the last few years, and it's not like the most VC type mental model, but, you know, the floor TAM for crypto has and always will be a 24/7 global casino, like hard stop. You have Bitcoin money, right? And of course there's the Ethereum money camp, but a lot of what crypto is an opportunity for people to speculate on a variety of assets. And every cycle has kind of been accelerated by a new capital creation mechanism, whether that be ICOs in the first cycle that we participated in, or yield farming in kind of the second cycle that we participated in. And, this cycle, I don't think we've actually seen that accelerant, although potentially it's just the ability to create new assets with near zero transaction fees. Like you can spin up a new asset on Solana for 0.5 SOL, and it's going to get botted, dramatically, but then you just have this kind of continuous asset creation. I think eigenlayer restaking will lead to kind of a boon in new assets. I think that things like Tau subnets will also lead to a boon in new assets, and these will start to accelerate some of the trends that we're already seeing in the private markets and moving forward into the public markets. We know the product market fit in crypto has been speculation and speculation enabling technologies. And I think that in a way that is a reaction to just a sense of, what people are calling financial nihilism. I prefer financial populism. It's just an opt-out of the current system that leaves people behind. You don't get access to private deals. You get kind of these public market deals, but they're already super overvalued and you're getting dumped on by VCs. I think in crypto, there's still a lot of opportunities out there. And the reason why people like memes so much is because the majority of them don't have these kind of private rounds where, the normal market participants can't get access to them and they feel like they're getting a bad deal. And so that's why I think they continue to take off and to capture the imagination. And, we've been talking about it internally, a mechanism, but every new protocol, every new L1 or L2 that's launching or has launched, every core infrastructure or block-based business, they want to attract wallets, they want to attract liquidity, and they realize that in order to do that, they need to attract attention. And meme coins are this mechanism of capturing attention. And so you have these really serious, highly technical founders who are now talking to us about meme coin strategy for their, for their L1 or their L2. And it's real, and it's probably stickier than we think, or than maybe many of us would like. But I think it's the same thing that happened. You had the OGs not really excited about DeFi, and then that led to this new crop of market participants who were DeFi native and just really excited about it. And then you had DeFi natives who faded NFTs, most of them, because they were JPEGs, whatever. And then you had this new crop that came in for NFTs. And all the while you had this kind of first proving out of the meme coin thesis with Doge and SHIB and Floki in this massive run. And now this cycle, it's okay, meme coins are solidified as a real market sector. And I think another point about just attention dispersion is the market has gotten so big that as a generalist VC, it's impossible. You have to pick a lane. I used to really value not having to pick a lane, and now, maybe you can max out on 3 narratives, but you could spend your entire day researching Tau subnets, in the BitTensor ecosystem, or AI as a thesis in general, every single day, and not sleep. And there's just so much to understand and to study that's enough, right? So imagine doing that, and then meme coins, and then Bitcoin L2s, and then the eigenlayer ecosystem, plus all the other stuff that's happening. I mean, there's a whole ecosystem on Telegram with the Ton token that's been, rising, and I don't hear any VCs talking about that.
Marc, given, I think, all of the lessons or points you've sort of made here around what you're calling attention dispersion during a bull run, and just given the competition for attention with all the different crypto communities, all the different, L2s, L1s that you can put your money to work there, you can invest in. Do you have any principles to guide us as, investors or users as to how to avoid the pitfalls, of every sort of bull run? I think a simple principle here could be don't chase shiny objects, don't chase what you don't understand, something to that effect. So anyways, any principles you can offer us?
Yeah, I think that's right on. And the way I would frame it, it's funny you asked this question because I was thinking about this recently, and I remind myself of this. You have to play your game. Like, we're 3 cycles, you mentioned you're 3 cycles in. I'm also 3 cycles in. At this point, as a 36-year-old, if I don't know what I'm good at and I try to play everyone else's game, I'm just going to get spread thin and lose. So find out what you're good at. And for the younger guys out there that are participating in the industry, it's often the thing that you're willing to stay up all night to do and not do it begrudgingly, right? And so where your curiosity takes you, follow that. I have a lot of trader friends. I live in a community where, that's just who they are. I'm much more oriented towards, investing in people and meeting great founders and being along for the ride and working with them. And especially early on in cycle, the traders get rewarded first, the ones that had conviction, because the liquid stuff takes off first before any new venture stuff starts to launch tokens. And it's easy to be like, oh man, like I should be trading more. I shouldn't be doing this venture stuff. And then all of a sudden the venture markets gets hot because the public market's led. And if I had just played my game and continued to look at seed deals, those have all re-rated 5, 20, 30x already in the private market to some extent in 6 months. So really, I think playing your game, and crypto really is just this giant meta game. And I think that's maybe why, so to some extent, people talk about Web3 gaming, and it's like, what game is more exciting than crypto? You have your strategy, you choose your fighter, right? And you pick what attributes that is and what you're good at, and you team up with a bunch of friends or strangers on the internet who you don't even know, but you build this camaraderie, and they have a set of superpowers, and you guys merge those superpowers, and you start to kind of just try to figure this stuff out and attack it in a way that, that you can win. And in bear markets, it's very PvP in the liquid markets, but it's actually much more cordial in the venture markets. It's funny, it flips. Bear markets are PvP with trading because people are getting chopped up and they're dumping on each other and there's not new money flowing in. In venture markets, it's slower. You could take 3 weeks to diligence a project, 3 weeks to close it. Nobody's chasing you down. Other funds are happy to have you in. You're all sharing deal flow. And then all of a sudden the bull market comes and it's like, oh, I need an allocation. You thought that dude was your friend. He's stabbing you in the back to get a couple $100K more in a deal. So anyways, circling back to the actual question, just play your game.
Yeah, I love that. And it just comes down to building your own conviction. I know it's cliche, but you really have to, because if you start outsourcing your conviction from other people, it's almost like that, if you're in traffic and you're in your car and you see the other lane moving, you're like, okay, I'm going to get into that lane. You go over to that lane and then it stops and you see the lane you were just in moving and you're like, man, why didn't I just stay in my own lane? I think that's huge. You have to have your own conviction, play your own game, whatever you want to call it. It's crucial. On that note though, Marc, I want to get into more VC perspective things from you. And I want to kind of do just a mixed bag and maybe kind of rattle through some of these rapid fire, because there's a number of things I want to key in on. So first one, maybe talk about, how you look at the structure of deals in VC. What stands out to you initially when you're sizing up a deal, and maybe even the importance of sizing your position?
Yeah, I think to your point about conviction, it really ties in with sizing. One thing I've learned from my partner, we've been working together for almost 4 years now. Andrew is exceptional at sizing with conviction. There is this trope in kind of venture and the way that venture funds are set up where it's every opportunity has to be 100x potential, or a fund maker, fund returner. and, we're going to write 30 checks and we can't cross a certain percentage threshold per an individual deal. And a lot of that is just kind of like the wisdom of, experience over a couple of decades of venture capital investing in Web2. But sometimes, you just see a winner and it. And I think with Arbitrum and Off-Chain Labs, for example, that was one where we would have done, almost our whole fund into that if we had the ability to do so. And I've seen, early in 2021, when I first started working with Andrew, I've seen him put 50% of his liquid portfolio into one asset and just be like, this is going up. And I'm like, okay, I'll do 5%, and I just can't mentally break that threshold of sizing with conviction. So you have to first have the conviction and build your thesis, and then you can size, because when you get to that size that's uncomfortable, if it's going down, where it's like, whoa, that's a lot of money I'm losing on paper. Can you double down on it? If you don't really have your own conviction, but you invested in it because your smart friend told you to, which happens all the time, whether you're a professional VC or not, let's be real. Who's the lead is my most hated question as a venture investor. And there are a lot of funds that ask it, because they just want to outsource their diligence to someone else. So yeah, you definitely need conviction. And when you have it, it's important to size appropriately.
Let's move on to vesting schedules. I mean, there's good investments that can sometimes start to look bad with a extremely lengthy vesting schedule. And then there's sometimes it can go the other way. If you think the vesting schedule is maybe too short. We just kind of love for you to kind of riff on vesting schedules in general.
I have a mental model for VC deals, for crypto private deals, let's say. And actually, the mental model is that some deals are private market deals, some deals are venture deals. And to your point about, this holier than thou syndrome that we can get in crypto, there's different layers of what people are willing to do or willing to accept. There's a lot of people that would shy away from the private market deal. And the private market deal, in my opinion, is basically a private to public market arbitrage opportunity. Based upon access, based upon network, based upon value add, perceived value add. This is what's happening now with a lot of what people are calling KOLs, but they're basically influencers or Twitterati or whatever. They're getting into deals pre-TGE at effectively a discount to the public market price. And there's a quicker vesting schedule on those deals. Some venture funds will shy away from those. Obviously, the deal needs to be evaluated in a vacuum, whether you like the team, whether you think it's in the right market sector, if the product makes sense, what the competition looks like, all of those things are important. But these opportunities are much more like trades than they are like venture deals. And then a venture deal is one where, this is a multi-cycle builder. You look at them and you say, this person has conviction. Someone like a Gabby Dizon at YGG. I met Gabby in 2018. He was building one of the first crypto games called Battle Racer. I was going on this networking, capital raising, and investing circuit with my fund, Wave Financial, and we brought teams with us that we had invested in. And Gabby was like a tag along. He was there with his friend Nix, who we invested in Nix's company, Open Data Exchange at the time. And Nix was like, "Can you connect him to some VCs out here?" And I was like, "Sure." And I learned so much about gaming itself and then Web3 gaming from him that we stayed in touch. And when he brought me YGG, I was like, Yield Guild Games, which was the first play to earn guild. I was like, absolutely, I'm going to back this guy because he eats, shits, and breathes crypto gaming. And he's never going to stop building in this space no matter what happens. And to me, those are the types of founders that I personally like to back, because we know that this is a cyclical space. And I just love the tenacity of a founder that has passion and is going to build through multiple cycles. And you might be like, well, doesn't every founder, shouldn't you just only back founders like that? There's also another, type of founder that is just exceptional at playing the liquid token marketing game, right? And the attention game that we're talking about. And if we are in a business that is trying to generate returns, I think the difficult thing for crypto venture investors to a certain extent is being like, I know that this is going to make money, but I'm not certain that this is going to be a product that will be used. And investing in that is almost accepting that a lot of the speculative premia in crypto are not tied to fundamental value. And like, you could say the exact same thing about a highfalutin, technical, modular scaling, insert the buzzword, infrastructure project that's generating $18 of revenue, but is trading at $20 billion FDV. The fundamental disconnect between the price and actual value creation for the community is huge. So when I hear investors that invest in projects like that kind of poo-poo this other type of investment, which is like the private market deal, I kind of laugh a little bit to myself because I think it's a little bit too much of a flex. It's like an NFT investor in Art Blocks NFTs saying that PFPs are below them, or a PFP investor saying that meme coins are below them. It's like at a certain point we need to accept, the parity of what we do here.
Yeah, it's like oh no, my fundamentals are better than your fundamentals. Like it's kind of hilarious, and that's like an excellent breakdown. And talking about Celestia without really saying Celestia, so maybe I said it.
I mean, Celestia is just like what I wasn't even trying to signal that out. There's many such cases.
Oh, I know, totally. Marc, the problem is I want to dive into everything you say more, but we got to ask you more questions here. Would love to get your take on tokens versus equity. A lot of deals come with equity with a token warrant, so you end up getting both. And you get in this land of, sometimes it's like, well, what is the founder valuing? Are they valuing the equity or the token? And what am I valuing? The example playing out in real time is Uniswap with Uniswap Labs and Uniswap token. And for the longest time, it's been the Uniswap Labs entity that's been, stockpiling profits, which is the equity side. So yeah, I would just love your take on how you guys navigate this aspect.
Yeah, I think as a principle, we, with exceptions, because there are always exceptions, we need both. Because the misalignment of incentives down the line is too real, and we've experienced it multiple times and been burned multiple times, where they do an equity only round and they won't accept a token term, a token warrant, or even just any token language in the safe. It's not even an equity round, it's really just a safe round. And then later on there's a token sale, and we get bad terms, frankly, or non-preferential terms to an investment team that came in a year and a half after us when the thing is de-risked at barely a higher valuation. And now, because they have a brand name, they're dictating what the terms of the token should be and how our vesting schedule should look. On the flip side, we've done token-only deals where, you're a purchaser of a token. You don't have investor rights. Now, you could make the argument that SAFT was actually a security, and therefore you should have investor rights and blah, blah, blah. But nobody really wants to make that argument. And frankly, we're not in the business of suing portfolio companies and never will. We've been people love to think that crypto VCs are just always crushing it. Man, the founder friendly terms that we sign in a bull market are insane. And no trad VC would ever sign these documents. And that's kind of the trade-off for some of these token only deals where you don't have rights. And the token launches 2 years later, and your terms were 15% unlock at TGE with a 1-year vest. And the new investor has said that that's not standard. And now all of a sudden, you're 2 years into an investment and they're telling you you're going to be locked up for 4 more. And I actually think that's poor form, frankly. I think it's poor form on the founders' part because they're changing terms on their investors, on contracts that were signed. But I also think, and we could talk about unlocks, it's something that we debate a lot with other funds and with founders. Frankly, unlocking a TGE is the best thing you can do if you've raised a private round. One, TG is when there's the most attention on a project, speaking of attention, and therefore the most liquidity and volume. And the impact of investors, selling some percentage of their investment at TGE is much lower. I've spoken to founders who wish that they had done this, and then they're left, waiting 3 years for just persistent linear selling pressure from their investors, rather than just getting them out. I was going to say something. Rather than just getting, the bad investors out, let's say, or the non-committed investors out that, maybe it was a mistake for having them on the cap table in the first place, quickly allowing the market, the liquid market, to price the token efficiently, giving public market investors the ability to come in at a reasonable valuation, and building a community that actually wins with you. If you're not going to do a fair launch, having an unlock at TGE is one of the closest things to a fair launch, because the market will price the asset more efficiently versus this Alameda FTX structure that was adopted during the last cycle, where it was like, we're going to do a 1-year lock and 3-year vest, 1% circulating. And all of a sudden you get these ridiculous fully diluted valuations, and everyone's like, FDV is a meme. Another framework I have is FDV is not a meme, because venture investors are realizing profit on the fully diluted value of the network. Now, FDV needs to be evaluated because there's different types of FDVs, some in which there's huge percentage of the FDV is unlocked, is basically locked venture profit. And then other projects like a BitTensor, where there's mining rewards that are coming over a fixed period of time, and all token holders are receiving that inflation. So really, you're getting diluted by inflation of the asset rather than by continual increases in valuation of new investment rounds.
Yep, love it. Yeah, there's totally times where FDV is definitely the most meaningful metric, and sometimes like circulating market cap is very important, just based on like how long that emission cycle can take to play out, or like maybe there's a massive amount of tokens that are locked in a treasury that will be for almost not perpetuity, but for a very long time. So it just kind of they're just kind of taken out of circulation. And I think this kind of like segues us into just like more ways for investors to kind of recoup on an investment. This is like never easy, but like kind of curious how you navigate, like if you want to sell something on the secondary market. So you want to take profit in an investment, you want to do it OTC, say you're still locked up or you're still vesting. You essentially have to find a buyer on the secondary market. And on top of that, you have to like tell the founder that you're doing this. I think you have to tell the founder you're doing this, like otherwise it's going to be a surprise to them. Like if you haven't enacted like certain transfer rights, like within your agreement, like, so yeah, would just love to see how you navigate that. And then just like you've touched on it a bit, but like primary market opportunities right now versus like open liquid market opportunities. I feel like we're getting into this like tipping point where, like you said near the beginning, like the venture rounds are starting to look really overpriced, like almost like speed running the liquid opportunities in some ways. So that's a lot of kind of in there, but yeah, if you can unpack some of that.
Yeah, I'll go the last question to the first question. So we're so back in liquid markets, it's so over in venture markets. It's like that kind of circular thing. It's so over in liquid markets, we're so back in venture markets, because right now we've now hit the inflection point of venture deals are overpriced. Bad teams are getting funded very quickly. By bad teams, I mean teams that are not committed to building and will disappear in a bear market cycle, and also aren't necessarily even qualified to build something that will capture attention in a bull market cycle. A lot of cash grabs, and overvalued, let's say, projects, because the FDVs of many assets, like I think the surprising thing for us as a fund in the last bear is how sticky these high FDVs were for infrastructure projects. And you guys touched on it before, saying like that game, that L1 rotation just keeps on working for venture investors. And so I think when you underwrite like risk return on some of these deals, it's like, okay, what's our base? Like if we go bear market again, what's the base valuation for a BTC L2 that has traction? Is it $1 billion? Is it $500 million? And we're talking about like the ability to basically make a highly convex bet that has pretty low downside. But valuations have gotten, I think still out of hand, that they're not pricing in execution risk. And I really hate the like, you have one day to close kind of vibe, because if I'm a founder, do I really want the investor on my cap table that's doing the one day close?
Huge red
think
flag.
About it.
Total red flag.
Yeah. But let's be real. Like we've all done that deal before. Like I've done that deal before. I've been like, oh, hell yeah, I'm in. Like sign me up, because the FOMO is real, even among quote unquote institutional investors. Like we're all retail plus, right? Like that's the irony of it. And when you look at venture markets after this run up, there's no better evidence of that fact than the way that these deals are getting done. So that's on kind of like the venture market structure. I forgot the first question though.
Oh yeah. I threw a lot in there on you. So just kind of this like idea of like other ways to get liquidity on an investment other than, directly, firing into the market.
Sometimes, first of all, yeah, like there's nothing worse to do for a team than to just like fire into like the UDV2 pool, just like large clips. A lot of them work with market makers. You can get size off over a long enough TWAP with a market maker. They often know where there are buyers, so founders can help connect. I think a mistake that a lot of teams make is being very, very strict on transferability. And the reason I think that is because if you have a willing buyer at a much higher price, they're much less likely to sell when the asset gets liquid. So if I'm a founder and there's like this big OTC market for a non-transferable, asset in the token pre-market, I would allow that. They can't explicitly participate in it because of regulatory issues, but I wouldn't like try to squash it, because basically when you have a big unlock coming, now it's a bullish unlock because you've already allowed this asset to change hands, more of an efficient market price to be found. And you're not going to have, some investor that's up, multiples on their investment and needs DPI to raise their next fund, to, dumping on you. And I think one comment on DPI, which is dollar per invested capital, I believe. And in venture markets, what that means is actually realized gains. And a lot of venture is done on an unrealized basis because, venture funds are playing a different game. Some of them are playing an AUM game where they're trying to clip management fees. And so they have this TVPI, total value per invested dollar, which is just the mark, the paper mark on an asset. And for fund 2 in a bull market, you can get away with raising your next fund on TVPI. But by fund 3, if fund 1 doesn't have actually some distributions to LPs, then people start asking questions. And so you will see a lot of selling from venture investors. And hopefully they're doing it in kind of like a structured way. The fear I have about this cycle is you don't have the large trad capital pools that we saw come in. And they're often late, but they got so burned. It's hard for me to imagine there being like a new Tiger emerging. It might be the sovereigns, but like, Tiger at the peak of market euphoria in January of 2022 was closing like in less than a week, like $50 to $100 million checks into some of these infrastructure projects. And I just don't know that incremental buyer is coming back into this cycle. So that's something that concerns me a little bit. And maybe to the earliest question of like what to look out for a top is watching like maybe hundreds of billions of dollars of value get unlocked that needs to be distributed to LPs in order for VCs to raise their next fund.
this was my first cycle raising money with a fund, and raising money in the shadow of FTX collapsing and Terra. It was a really unique experience. I wouldn't wish it upon my enemies. Glad that we're just brutal. Ideally, if you're raising, raise at the top of the bull run and save yourself a lot of heartache. But on to better things. Marc, there's so much more I want to dig into with you, but I'm thinking a good place for us to start to wrap up the conversation. Like one thing I wanted to discuss is just bubbles. Like, how do you continue to invest this cycle, knowing that there are inevitable bubbles? Like, I think like two of them I wanted to highlight, and maybe we can speak to like, how do you think as a fund that is investing long-term, but you're not blind to, you know, the short-term market movements, like you mentioned, having a lot of friends that are traders. I am not a trader, but I also too like stay very in tune with my friends who are trading, you know, daily or doing swing trading, you know, week to week, month to month, whatever. So I'm looking for like, where is that top of the crypto market cycle? And I'm thinking about the bubble or bubbles that will burst the mega crypto bubble this cycle. And two of those in particular is crypto AI. I don't know if we're actually in a bubble yet with it. It really does feel like we're still so early on. Like there aren't a lot of tokens. If you look at the total addressable market of all the tokens that would classify under crypto AI, I'm guessing it's a very small fraction of the total addressable market for crypto. And then the other one that we're all of us here are invested in is whatever falls under eigenlayer. All of the LRT protocols, the future AVSs, actively validated services, which we won't talk about here in too much detail. So how are you thinking about that? Like, I feel like it's too costly not to get exposure to these, because we're thinking years out, of course. You know, we're invested, 4RC is invested in EtherFi, and we're very proud of that. We see Mike as a long-term builder. I know you guys are invested in Renzo and Swell, two other just, you know, really strong teams, builders in this space. How do you approach this? How do you invest in a cycle with these bubbles growing rapidly?
Yeah, it's a really good question. I think you know, this is not actionable advice, but the best way to do it was to have chips on the table already, to have placed your bets and back teams in these specific market narratives, you know, even 8 months ago, because everything is repriced dramatically. Like, I mean, I don't want to speak to specific deal terms, but, you know, LRTs went from struggling to raise at 20 to 30 million, you know, in the spring and summer of just last year, and now are closing deals at, you know, $100 to $200 million FDVs. Bitcoin L2s were the same. That's another area. I've been focused on 3 market areas since Ordinals launched to build on Bitcoin narrative, and that was like February of last year. The eigenlayer narrative, as you said, restaking, and AI. The Bitcoin L2s are now, I think, fairly priced. They're kind of in a similar boat, 20 to 30 million, now at 100 million, and some of them raising at 500 to a billion. And AI was kind of the last one to get re-rated. I think that leading teams in AI are now able to raise in the kind of, call it like $300 million to $1 billion zone in private markets. A lot of it is kind of the deep-in part of AI, which is just like NVIDIA's ripping, so these compute networks should be super valuable. Render has re-rated dramatically, and therefore Akash, you know, has, and there's IonNet that's raising, and Aether, and many others. And I think that then AI was kind of the last one where you could still get reasonable valuations with good teams but I think that ended about a month ago. And so now in the private markets, I think you're in a position where you either consciously agree to pay up and reduce your return threshold because you think that the downside is limited on a specific project, or you just wait. As an individual investor, who many of the people listening to this are, you can play liquid. And I think that watching the VC capital is valuable because it shows you who are going to have the most hype launches. And there's something to be said about, Celestia. My understanding, and I didn't do the round, so I can say this, my understanding is they closed their last private round was $1 billion FDV. You could have gotten a lot of size in Celestia at like 2 on liquid markets. So a 2x to what private market investors paid, who were locked up for 4 years, and rode that up and had complete liquidity. And I think as a fund that is a hybrid vehicle, we ask ourselves when deals get super expensive, like I have a newish category where I just flag it as ape the launch, right? Because it's so hyped and there's so many people chasing over themselves to get into these deals. And we're back to the 3 tranched round where it's like simultaneously closing a seed A and A plus at like the same exact time, but just based on the quality of investor, perceived quality of investor. That I think when I see those deals, I'm just like, I'll ape the liquid, and just do that instead. And that's kind of cool too, because public market participants have, I think, better return potential. Maybe they're not going to be able to nail the 100x, but they can get size and liquidity into deals that still have, 5, 10, 20x potential, even in a bull market. Bubbles, I think, what L1s have shown us is that the imagination TAM, the what can be TAM of infrastructure is much more valuable to market participants than something that you can fundamentally value like a DeFi protocol. It's almost like having clear cash flows is a burden to a project's fully diluted value. And it's akin to in VC world, trad VC world, where they would basically say like, don't generate revenue because it's like that classic like Silicon Valley scene where he's like, revenue's bad, like just grow and just keep reinvesting because, once you start generating revenue, you start getting valued on revenue multiples. And I think the thing about AI that is, maybe like one of the smartest VCs in the world in crypto would never say this on a podcast, but it's got a TAM that is just unclear and extraordinarily large. And it's like, use your imagination. How big can it get? And I think that's why we're going to see a complete re-rating. One of my founders put like AI 1 trillion this cycle. I don't know if I agree with that, but when the entire fully diluted market cap of AI coins publicly traded is less than, Ethereum, or even less than Solana, I think if you expect Bitcoin 150, maybe ETH 10K this cycle, where can these AI tokens go? And the cool thing about, as you get deeper into it, like you could approach crypto AI as a cynic, but when you start talking to some of these teams, it's like, wow, this is like huge. There's a team building a protocol called Grass that are doing, data scraping. And I didn't realize how big that market was. Obviously, the market for compute is massive. I mean, BitTensor is one of the coolest experiments I've ever seen in that, one of the subnets has already gotten up to GPT-2 level intelligence because of the incentivization structure of, the subnet. And that growth happened pretty rapidly. So why can't we, merge open source and crypto economics to incentivize the creation of real intelligence? I think that's really interesting. So there's a lot of subcategories within AI to explore. I think it's frothy in the private markets. I think it will get really frothy in the public markets. Eigenlayer, just to answer your last point, we missed that round. The there was a private round that we were excited about. We were researching it. We got kind of through on. We didn't get into it, but I basically started evaluating the whole ecosystem, and we put a couple of investments into LRTs, and I invested personally in Ion Protocol. Chunda is an amazing founder. I think there's a couple of other projects that are kind of like on the meta. I did Drosera, which is an ABS focused on security. I think there'll be a lot of opportunities to invest in ABSs. I think that leverage is always the thing that leads to market cycle tops, and restaking is an inherently new mechanism to lever. And so I don't necessarily think it's a bad thing, but we do get into these really overextended trends. And I think that we probably see some kind of slashing event that could be the beginning of, the correction in the next cycle. That doesn't mean I think we should not experiment with EigenLayer. I think it's going to be incredible to see what kind of middleware gets enabled through basically being able to bootstrap your security with Ethereum.
I think that might be potentially a top for this cycle. I hope it doesn't happen, but I think it is inevitable. We will have some big slashing event. Maybe we'll be fortunate to get through this cycle, and EigenLayer will be able to mature more before we do have some major slashing event. But yeah, it feels like the thing that a lot of people who are probably depositing into EigenLayer or through LRTs, that it's the thing they don't quite understand. They just know that they're going to earn additional yield. And actually the truth behind SWELL and Renzo and EtherFi and Puffer and KELP, as far as we know, having interviewed them, is they all seem very conservative. They are not looking to maximize yield. They're looking to protect that principle. But that all said, this is all in theory right now until this thing is fully live and running. So yeah, it was definitely one of the most talked about topics at ETH Denver. And I definitely came away with that thought that this will happen. I hope it doesn't, but it just seems like someone's got to get slashed at some point. Someone will give in to the notion that they should just maximize earning as much yield despite the risk. And I think that could potentially be a mistake. But guys, I think this is a good place for us to start to wrap up. There's so much that we didn't cover. I feel like we should just pre-schedule a follow-up interview, because one thing that we didn't get to pick apart with you, Marc, is blockchain gaming, Web3 gaming. That's something that you're clearly an expert in, and also Bitcoin DeFi. So I want to remind our listeners that they can first follow you on Twitter. It's just Marc Weinstein, but he's flipped the two first letters of his name, so it looks like Wark Weinstein. And then you should also follow Mechanism Capital. It's just Mechanism Cap on Twitter as well. You can learn more about Mechanism by going to mechanism.capital. And then Marc would like to give you the final word on this. I don't know if it's possible to summarize your thoughts in 30 to 60 seconds on each of these, but why is this time different for blockchain or Web3 gaming? And why is this time different for Bitcoin DeFi? These are two sectors I know Nomadic and I are both investing in and paying very close attention to. Would love to just kind of get your high level thoughts. Maybe this is a teaser for a follow-up conversation we could have.
This time is different for Web3 gaming because of playable games on par with, tier 1 studio launches that will be coming and are coming. Heroes of Mafia, for example, is an enjoyable game akin to Clash of Clans. I think that's one of the first, and there are many on the way. Ordinals changed the game for Bitcoin, and there's that classic show me the incentive and I'll show you the outcome. And when I think about who are the most incentivized players in the crypto market to make basically build on Bitcoin a success, it's the miners and the exchanges. And so if they're both incentivized, the exchanges are incentivized because there's a new suite of assets that are launching that will lead to more volume. the miners, I mean, have you seen Bitcoin transaction fees? It's bananas. And Bitcoin whales will have the ability to use their Bitcoin in a way to earn, hopefully more trustlessly than had been available before. And BitVN may actually enable ZK rollups on Bitcoin. And so you get this kind of like ability to use this really hard asset with a ton of liquidity. I think that could create, massive protocols, and some of these Bitcoin side chains, or Bitcoin L2s, will reach arbitrum level of valuations, I believe, this cycle. So I think incentives on the Bitcoin L2s have never been stronger, and ordinals kind of changed the game and showed that Bitcoin can be more than just a pet rock, and Web3 gaming is playable games.
Marc, thanks so much again for your time, and we got to do a follow-up. I feel like we need to schedule it as soon as possible, but just thank you so much for sharing all these insights.
Thank you guys. Yeah, this has been awesome.
Thanks everyone for tuning in. If you're a talented founder or developer, please consider reaching out to our team at fourthrevolution.capital. And for future episodes of the Edge podcast, please check out our link tree at edge_pod.